It is a tough time, I think, for so many people in the world, but certainly from the point of view of a central banker. Um, Setting your forecast, setting your plan to fight off the damage from the coronavirus in New Zealand. Your view of the economy right now has four scenarios, and they range from something like the quarterly GDP number coming in at -4 or -37%. How do you set policy? How do you manage when there's so much uncertainty about where we are, where you are, and where we're all going?
Great questions, and I certainly don't feel we need sympathy. I mean, being a central bank governor at this point is not only challenging, but very exciting. And I'm pleased that we will still remain employed for the time being. So I feel privileged rather than pressured. But in terms of setting the policy, while the challenge is probably in terms of the outlook is the hardest ever, in terms of what we need to do is probably the easiest ever. That the shock is global, it's significant, it will persist. Fiscal policy is the first cab off the rank, and monetary policy is playing a bit part, really, a significant bit part. But so for us, the obvious decision is as much as we can do, as soon as we can do, with regard to easing policy and keeping interest rates low and that yield curve flat and stable. To pretend we can do that with accuracy would be wrong. There's no sense of perfection. That's why we call it scenarios rather than predictions. But it's very clear: quantitative easing, significant, and keep an eye on low and flat yield curve.
Well, speaking of the keeping the yield curve flat, watching fiscal policy, certainly the budget released by the government last week, I think, before it came out, and even after, people are wondering what it means for your target for bond purchases this year. And of course, your assistant governor, Christian Hawkesby, spoke to our Tracy Withers earlier today, saying that didn't really change much. So, but to get back to this bigger picture question, are you really only basing your sense of how many bonds you're going to have to buy or want to buy, how you're going to keep the yield curve flat, how you're going to keep your yields low, based on how many the government is issuing? Are there other factors that are equally important to that?
I think there are other factors that are actually the driver. Just to step back one, we have chosen to use quantitative easing, the large-scale asset purchase, as our preferred instrument, given that the official cash rate is so low. We don't want to go negative at this point. We're prepared to if we have to, but not until a lot later. So government bonds are the obvious asset we can be purchasing. The good news is there's more of them coming on the market. When we were talking about alternative monetary policy tools this time last year, one of the concerns for New Zealand, given the very low fiscal debt position, was that we didn't have a lot of government bonds to actually buy. Well, that problem is certainly being resolved for us now. The way in which we think about it to retain our operational independence is that we think about the cap in terms of dollar billions of assets we want to buy. We don't think about it as a percent of total assets on offer. Of course, we get indemnified from the government for buying these bonds, around the mark-to-market positions, and that indemnification is set as a percent of the total bonds on offer, but that is not about our policy. That is simply about enabling, not about what we have to do. So we focus on inflation, we focus on employment, and we are targeting, a low and flat yield curve through the purchases of bonds.
So you also mentioned, the global outlook. Certainly one aspect of the global outlook for New Zealand and what the economy is going to do, and that all over the map forecast, is what's happening in Australia, what's happening in China, your two biggest export markets. How do you see China's economy in particular performing right now, and what is that going to mean for demand for New Zealand's exports, which is a very big part of your economy?
That's right. I mean, we're in a reasonably fortuitous position, put it this way. If you wanted to confront a crisis like the globe is confronting, you'd want to start from where New Zealand started. So we had a pretty good terms of trade, good high commodity prices. We had low government net debt. We had very high labour force participation. We had inflation above the midpoint of the band. So all of these are good starting points. But without doubt, both New Zealand and Australia are trading nations. We need people to buy our goods and services. For us, for New Zealand, our particular goods still remain well bid, well sought after, because they are soft commodities. They are food, they are timber, fishing, things that really remain in demand in China, and they are largely consumed there. They're not part of a global supply chain that ends up getting held up somewhere else through final demand. I mean, final demand is China. So that is good. Australia's a little bit different, with their harder commodities. A lot of those are intermediate inputs or primary inputs into ongoing further processing. The biggest part that is impacting the New Zealand economy from the Chinese slowdown and global slowdown is the fact that we can't travel, and tourism and education is a significant component of both our countries' GDP. China in particular for the education, and more so recently China for tourism. They've come up into the middle income group. During the global financial crisis, Chinese tourism was not a big issue. Now it is. So that is, that's the biggest challenge, not necessarily goods, but more services and at that high end, labour intensive service area.